Chinese e-commerce giant Alibaba recently reported their earnings for the quarter ending December 2022, and the past couple of years has been really rough for Alibaba, not only in terms of their stock performance, but also in terms of some of their underlying business struggles. The stock is down about 70% from its highs in 2020, and Charlie Munger, who really got a lot of people interested in Alibaba through his investment in the company via the Daily Journal Corporation, recently admitted to Alibaba being quite a significant mistake, and here is exactly what he had to say on that topic.
I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer.
But despite all of that, these latest numbers out of Alibaba really had far more positive news than it did negative news. And in this video, I want to give quite a comprehensive overview of all the things that were reported by Alibaba for this latest quarter. We'll go through some of the opening comments from Alibaba CEO Daniel Zhang. We'll also look at the high-level financial results, the revenue, earnings, free cash flow, balance sheet health, and capital allocation and share buybacks that Alibaba are currently going through. We'll look at the individual segment performance. So how is Alibaba's Chinese e-commerce business stacking up versus the cloud business versus their logistics business and so on. And I also listened to the about hour and a half long conference call and Q&A session that management had with a range of different analysts. So I'll share some of my highlights from that Q&A as well. So sit back and relax, and if you haven't subscribed to the channel already and you enjoy this type of content, please be sure to subscribe. That certainly does help me out a lot. But with all that said, let's get straight into this latest update on Alibaba. Now, just for a little bit of context before we get into some of the specifics here, this quarter ending in December 2022 is going to be really another COVID-impacted quarter for Alibaba. It's going to include periods of lockdowns, which were significantly impacting consumption from Chinese consumers, which Alibaba is obviously very, very heavily exposed to, given that they are a giant e-commerce player in China. And in many ways, this quarter represented a continuation of some of the things that we were seeing last quarter. We're seeing largely flat revenue growth, although quite significantly improved profitability through many of the cost reductions that Alibaba have been making, particularly in their more loss-making businesses. And we also continue to see a real kind of simplified way in which Alibaba are managing their free cash flow rather than going out and making a range of different complicated and confusing acquisitions. They've really dialed that way back, and they are largely funneling a lot of their free cash flow towards share repurchases, which of course increases the proportional ownership of every share for remaining shareholders in Alibaba's existing businesses. And Daniel Zhang, the Alibaba CEO, started off this quarter's earnings call by saying the following: despite these challenges, we delivered double-digit year-on-year growth in our adjusted EBITDA and the free cash flow through effective business management, cost optimization, and operating efficiency. With the lifting of COVID-related measures that end our peak wave, everything is now quickly getting back on track. In general, consumer confidence and business confidence are rising, logistics has resumed normal operations with the entire supply and manufacturing chains becoming active, and digital transformation across industries and sectors has accelerated significantly. Against this backdrop, our various businesses are showing positive trends. Recently, the International Monetary Fund raised the estimated GDP growth for China to 5.2% this year. Given the expectation for economic recovery following the lifting of COVID-related measures and China's reopening, I have chosen progress as the key word internally to set the tone for Alibaba's development this year. And before going on to present the detailed financial results, Daniel Zhang did share some thoughts on a few of the different segments of Alibaba's business at quite a high level. He explained that GMV, or gross merchandise value, at Taobao and Tmall were down mid-single digits year over year. Now, Taobao and Tmall are really the two giant e-commerce businesses within Alibaba. They move the needle a lot depending on how they are performing each quarter and each year. But he explained explained that even though the GMV was down year over year, they also saw interesting changes in product mix. So they saw less discretionary spending on things like apparel and increased spending through subsidiaries like Alibaba Health. And taking a slightly longer term and more forward-looking view, he explained that all of our merchants have also expressed their strong desire to get to business. We expect this recovery will continue. He highlighted 3 ways in which he sees Alibaba's e-commerce businesses as remaining competitive. He said they'll focus on enhancing user stickiness and time spent with new content introductions such as short-form video and live streaming. He explained that they want to enhance value for money. At the end of the day, price is quite an important factor when people are shopping around for different items. He explained that they'll probably look at doing that in a couple of different ways, one through marketing campaigns, but also through slightly different retail models, going direct from factory to consumer, for example. That will allow them to cut out some middlemen and lower the end cost to the consumer. And thirdly, kind of doubling down on what he called digital retail, people buying their daily necessities and Alibaba providing consumers the option to have those goods delivered directly to their door. He noted that the international commerce arms for Alibaba continued to grow very quickly. Trendyol, for example, order volume was up 50% year over year. Lazada profitability continues to improve. Lazada is currently a loss-making international commerce arm for Alibaba, but their losses per order reduced 30% year over year. And AliExpress returned to growth after a range of different VAT, tax, and foreign exchange issues that have really been a headwind for them in recent times. He noted that Cainiao, the logistics business at Alibaba, is now 10 years old, and as an interesting stat, on Singles Day, or 11th of November, on their peak day, Cainiao delivered 18 million orders from Taobao and Tmall, which is just crazy impressive. And they are now up to having 15 international sorting centers, having put quite a lot of investment into sort of international expansion of their logistics and supply chain network. The cloud business at Alibaba, a little disappointingly, only grew 3% year over year. The cloud business at Alibaba is not a huge component of their revenue just yet, but it is kind of just reaching the level where it's now profitable, and it is one of the more exciting elements of Alibaba as an overall business. So to see only 3% growth year over year is a little disappointing, but one of the things that really jumped out to me is that as of late 2022, Daniel Zhang, the CEO of Alibaba, is actually now also the CEO of the Alibaba Cloud business. So that is quite a significant management change, and we really haven't had the time to see how that plays out just yet, but that will be something to watch very closely, whether that has any material impact on their growth. And finally, Daniel Zhang noted that this is Alibaba's 24th year, and in traditional Chinese culture, that means they've gone through 2 complete calendar cycles. He said, we've captured 2 historical opportunities of e-commerce in China for the consumer internet and the start to cloud computing in China for the industrial internet. He went on to say, we will continue to capture the vast opportunities ahead. Okay, so moving now to some of the financial results that Alibaba actually reported for the December quarter. Now, at an overall Alibaba group level, revenue was largely flat. It was up 2% year over year for the quarter, but income from operations was up 396%. Now, I would basically completely dismiss that number, actually. Alibaba certainly is improving their profitability, even with limited revenue growth, but that particular number does include quite a large goodwill impairment, which really skews that figure, so I would largely ignore their income from operations number this quarter. But in some of the non-GAAP, non-generally accepted accounting principle measures where that impairment is not an issue, the numbers still looked really good. So adjusted EBITDA, which is sort of the profitability proxy that Alibaba tend to report across a lot of their business, was up 16%, and they reported a 21% EBITDA margin, which was up 3 percentage points from the same time last year. Non-GAAP net income, again excluding any of those weird kind of goodwill impairments, was up 12% year over year, and on an earnings per share basis, things were up 14% year over year, representing that Alibaba have retired some shares in the past 12 months, so the per share earnings look a little healthier than the overall kind of absolute net income. So again, similar to last quarter, very modest revenue growth for Alibaba, but pretty significantly improved profitability, mainly through kind of rationalizing a lot of their costs. And Alibaba did share quite a bit of detail on the components of their overall cost structure and how some of those things were changing. Now, in terms of their cost of sales or cost of goods sold, that remained flat year over year at about 60% of revenue. That's quite encouraging from my perspective when Alibaba are talking about one of the initiatives in their retail business, being remaining competitive on price. You really wouldn't want to see that in shrinking gross margins and just discounting product and so on. So to see the cost of revenue flat at about 60% year over year is a nice sort of encouraging sign that Alibaba aren't doing anything too dramatic with just slashing prices and giving product away. Sales and marketing as a percentage of revenue shrunk from 15% down to 12%. Product development as a percentage of revenue was flat at 4%. General and administrative was flat at 3%. So overall, everything is either flat or coming down in terms of the costs as a percentage of revenue. So really all good news on that front. Now here is where I think we start to get to some of the really interesting stuff, which is the operating and free cash flow that Alibaba are generating, kind of what they're doing with that free cash flow, which in this case is largely share repurchases now, and also how much cash they still have sitting on the sidelines, because Alibaba's CFO described themselves as having quite deep pockets after this quarter, which I think is a pretty probably accurate representation of where Alibaba's balance sheet currently sits. So in terms of operating cash flow, things were up 8.7% year over year to 87.4 billion RMB, or about 12.7 billion US dollars for the quarter. Free cash flow was up 14.8% to 81.5 billion RMB, or about 11.8 billion US dollars. If we look through sort of the quarterly cadence of free cash flow for Alibaba over the past few years, the fourth quarter is always a very strong one. So to see this quarter be even stronger than is typical is a nice sign as well. So we have higher operating cash flow, less capital expenditure, so even higher free cash flow. And the way in which that free cash flow is being allocated is, like I say, largely towards share repurchases. And to me, that free cash flow is now being used a little more intelligently. They reported substantially lower spend on mergers and acquisitions. In fact, they had a net cash inflow from their investing activities. So instead of allocating money outwards to make acquisitions, it looks like Alibaba likely sold some of their previous acquisitions in this quarter. So they actually had a net cash inflow from investment activities of a little under 1.9 billion RMB versus an outflow of 4.7 billion RMB at the same time last year. And the big one here in terms of repurchases is they spent 3.3 billion US dollars to repurchase 45.4 million of their ADSs. Now, just doing the maths on that, it looks like they paid an average price of about $73 per share on their share repurchases, which is a little bit lower than where Baba currently trades on the New York Stock Exchange. And just going through the maths, it looks like even though those buybacks are offset by some stock-based compensation, the overall number of shares outstanding shrunk about 1.4% just in that single quarter. And after all of that, Alibaba continues to have a very healthy balance sheet. They had 55 billion US dollars of net cash, so all their cash minus any debt, net cash of 55 billion US dollars at the end of the quarter, which as of recording is about 23% of the market cap. Alibaba's market cap is a little under 240 billion as of recording this, so a huge chunk of that market cap is just cash at this point. And they also noted that they still have about 21.3 billion US dollars remaining under the current buyback authorization, which runs through to March 2025. So again, in terms of the cash generating ability of the business and where that cash has been kind of funneled towards, as well as just how healthy a position Alibaba are in terms of cash on hand, it really is all positive news as far as I can tell this quarter. Okay, so let's move now to some of the individual segment results and performance for Alibaba and have a look at how some of their different lines of business perform. So China commerce versus international commerce versus cloud and so on. And I'll go through the business units from largest to smallest because some of them represent a huge portion of Alibaba's business and some of them are very, very small, and I'll try to give some context on exactly how significant they are for Alibaba overall as I work through each of these segments. So let's start off with China commerce. Now, China commerce for the quarter represented 69% of revenue, so a huge chunk of Alibaba's business from a revenue perspective, and get this, it represented 113% of adjusted EBITDA, which again is kind of the profitability measure that Alibaba tend to use. So it represents more than 100% of their profitability because Alibaba also has some loss-making businesses in the mix as well. So China commerce, very, very, very important to Alibaba's overall business, and this is how things were performing. So revenue for the quarter was down 1% versus the same quarter last year. Adjusted EBITDA was up 1%. They noted that that was largely driven by reduced losses in Taobao Deals, Freshippo, and Taobao. And EBITDA margin on the slide here, it's reported flat at about 34%. There's a little bit of rounding in there, so if you do the math yourself, it was actually up about 0.8% year over year. Interestingly, they did actually have a slight change in their revenue mix, and this is something that I'll touch on again when I get to the Q&A section here shortly. But their customer management revenue was down about 9%, and their direct sales was up about 10%. Now, they noted that their customer management revenue was down that much. It sounds like largely because of some shortish term logistics issues. They had a lot more cancellations due to just logistic problems with COVID restrictions and so on, which caused that customer management revenue to come down. And the direct sales revenue was up again, largely because of changes in product mix. So good growth in Alibaba Health as an example. So overall, a largely flat quarter year over year for Alibaba's China commerce business. That includes some of the giants like Taobao and Tmall. And just the fact that it's 69% of revenue and more than 100% of profitability probably provides a pretty good argument as to why you might want to approach valuing Alibaba on a more of a sum of the parts basis as opposed to trying to value the overall pie. I think if you can get into a little more of the detail of the value of the different components, that might be a better way to go about it. Although a lot of their businesses are loss-making right now, that certainly doesn't mean they have a negative value. So some of the parts could certainly make sense here. Okay, moving now to the international commerce segment for Alibaba. International commerce represents 8% of revenue, so much smaller than the China commerce business, and it's currently a loss-making segment for Alibaba, although as I'll touch on, the negative margins are getting less negative over time. And in terms of some of the brands and sort of websites that international commerce includes, this is going to be Lazada, AliExpress, Trendyol, and actually Alibaba.com itself as well. So international commerce revenue was up 18% year over year. A little bit of a change in mix here again. So international retail was up 16%. That's going to include, again, businesses like Trendyol, which is a largely Turkey-based fashion retailer, I believe. And international wholesale, so Alibaba.com in this case, was largely flat in terms of revenue. EBITDA margin improved from negative 18% to negative 4%. So it's still loss-making, but the losses are definitely getting narrower, and they said that was mainly from reduced losses in Trendyol and Lazada. So Trendyol here is starting to become quite a good example of one of Alibaba's businesses that, yes, is currently loss-making, has been loss-making for some time, but Alibaba's strategy typically is to scale these businesses really fast, try and get a good kind of large business, good revenue base, and then focus on improving profitability later. And, the narrowing losses and the still really strong growth in revenue is starting to show that a business like Trendyol is really getting to scale. Next up, we've got local local consumer services, this is about 5% of revenue and is currently very loss-making. Alibaba have quite negative margins in this segment, and it includes businesses like Ultima, which is sort of like an Uber Eats equivalent as far as I can gather in China, and also AMAP, which is like a mapping and navigation software. AMAP is used by individuals, but it's also actually sold to auto manufacturers as well. So in terms of revenue, that was up 6% year over year. They noted that was mainly driven by higher order value of their Ultima deliveries, and margins went from negative 41%, which is pretty horrific, to slightly less horrific, negative 24%, again mainly driven by some of those higher order values. Next up, let's talk about Cainiao, which is the logistics business at Alibaba. And there's a couple of businesses in this list here, and Cainiao is an example of one of them, where there's quite a bit of kind of cross-pollination between, for example, China Commerce and the Cainiao logistics business. So the numbers that Alibaba tend to report here are after what they call cross-segment elimination. So they clear out some of that overlap and cross-pollination between some of their businesses. And Cainiao represents about 7% of revenue, and it's about a break-even business right now. So this is going to include logistics for both domestic and international. Revenue was up pretty significantly. It was up 27%. They said it's primarily from what they called a better customer experience. I don't know exactly what that means. Potentially less cancellations, but I'm really not entirely sure. But they also noted that there was quite an increase in international fulfillment services, so presumably that allowed for a bit of a revenue bump as well. And they noted that 72% of revenue now comes from external customers, so non-Alibaba businesses. And margins, like I say, it's about break even, so it went from negative 1% to about 0%. Next, let's have a look at cloud. So cloud for Alibaba is about 8% of revenue, and it's next to nothing in terms of their profitability. Again, it's another one of these businesses that's just breaking even. And the cloud segment includes a couple of different things for Alibaba. So it includes Alibaba Cloud, as you might expect, but it also includes DingTalk, which, as I understand it, is a pretty similar product to something like Slack, just I guess a Chinese version of something like Slack. Now, Alibaba Cloud is the leader in terms of market share and cloud spend in China, but they have been losing market share a little bit over the past year or so. So back in 2021, they had about 37% market share in terms of cloud spend. That seems to have dipped to about 34% is the latest data I can find. It seems like Huawei Cloud are starting to take some of that share potentially from Alibaba. At the same time, 5 years ago, Alibaba's cloud segment was about 4% of revenue. It's doubled now to about 8% and was growing very fast, but the growth has certainly slowed a lot. So revenue for the quarter was up 3%. They noted double-digit public cloud growth offset by a reduction in hybrid cloud revenue. They noted they're looking to shift towards what they call higher quality recurring revenue growth. And margins went from 1% to 2%, so only a 1% gain, but going from 1 to 2 is a double, so significantly more profitable, but really not a lot in the grand scheme of Alibaba. They did note again, and this has really been going on for a lot of quarters now at Alibaba, that some of their limited growth can be explained by the loss of their largest customer. They didn't disclose exactly who that was in this quarter, but it's fairly widely rumored and generally accepted that it's probably ByteDance and TikTok. They have been moving from using Alibaba Cloud Services to a US cloud provider. So that is a big revenue hit by the looks of it for Alibaba's cloud segment. But it's also really quite interesting how long that transition away from Alibaba Cloud has taken. It's probably a little bit of an indication of just how sticky some of these products are. And finally, we have the digital media and entertainment segment. This is only 3% of revenue and it's just breaking even. This includes Alibaba Pictures and Youku, which like a Chinese version of YouTube, considering that YouTube is banned in China. Revenue down 6% and margins went from negative 17% to 0%. So they went from losing a lot of money to about break even. And finally, they have sort of like an other bets category, similar to Google, I suppose, called Innovation Initiatives and Other. It's 0.3% of revenue, basically nothing. The margins are absolutely horrific, like negative 150% margins, but it's very, very small. So the actual amount of money being lost is really not that significant for Alibaba. In that segment, nonetheless, revenue was down 20%. Margins went from negative 156% to negative 150%. And the CFO, Toby Zhu, didn't actually even talk through the results for that segment. That's how tiny it is. So overall, very similar themes across a lot of Alibaba's different business segments. Kind of flat to modest growth in most of their major lines of business, and pretty significant improvements in margins across almost every business. And we're really seeing that flow through to greatly improved profitability at the overall Alibaba group level. It'll be quite interesting to follow how Alibaba can potentially continue some of these cost reductions. Hopefully they are not kind of sacrificing any long-term growth opportunities for the business, but it certainly looks, really good in some of their recent profitability results. Now, finally in this video, I want to just go through some of my personal highlights from the Q&A session that happened with management. There was a lot of really good questions that came across from analysts, some more long-term focused than others, some more short-term focused than others. So I've picked out a few that I found quite interesting in terms of the questions from analysts and then comments from the CEO and CFO. Now, there was a great question right at the start, basically going through Daniel Zhang's comment about how, they've gone through 2 of these 12-year Chinese calendar cycles now, with Alibaba being 24 years old. And the question basically was, what are the opportunities long-term in the next 24 years for Alibaba? And Daniel Zhang, the CEO, said their 3 core strategies remain consumption, cloud, and globalization. And when he says globalization, he's talking about globalization of consumption and cloud. Now, he went through some really interesting stats here in terms of the actual opportunity set with comparing China to a much more developed kind of e-commerce and cloud market like the US. He said, we think that in those 3 areas, the ceiling is high enough and the market is big enough. There's more than enough for us to accomplish there. In terms of consumption, the International Monetary Fund forecasts 5% per year GDP growth in China. Imagine where we'll be in 10 years. He also noted that as a percentage of GDP, consumption in China is low and will likely grow too. I did a bit of digging on that, so it looks like consumption as a percentage of GDP in China is currently about 38%, or at least it was in 2021, it was 38.2%. That compares to the US, where in 2022, consumption as a percentage of GDP was 68.5%. So pretty significant room to move there in terms of China moving a little closer to where the US are in terms of consumption as a percentage of GDP. So you potentially have a couple of different engines here on Alibaba's side. One is just overall GDP growth, and 2 is the kind of components of GDP in the future, hopefully moving more towards consumption, at least from Alibaba's perspective. Similar comments on cloud computing. So IT spending as a percentage of GDP in China is about 1%. In the US, they said it's as high as 5%. And within those IT spend categories, cloud spend in China is about 15% of all IT spend versus about 21% in the US. So I said these are not just trends in China, but for the world, and we intend to take our offering to the world. Now, there was a kind of 2-part question here from another analyst, firstly asking about, what is Alibaba's sort of plan in 2023. In 2022, a key theme was removing a lot of unnecessary costs and improving profitability. So kind of what's the balance going to be between profitability and growth and so on for the coming year? And also what's the kind of competitive landscape look like, and what's the market doing right now in terms of consumers coming back and purchasing in a strong way again. They said January was still a challenging time, but life and work began to normalize around the Lantern Festival, which is about the 5th of February. They said merchants have a strong desire to get back to business to try and have a bumper year and make up for what they lost. In terms of e-commerce competition, there was also a question in there around kind of price subsidization. So companies just pricing products very cheaply, taking a loss on it and trying to grow their business really fast just kind of for the sake of growth. They said price subsidies are nothing new. Every couple of days, somebody out there comes up with a bright idea to try and engage in heavy price subsidies in order to win more opportunities and turn around their business. But in history, no player ever has managed to achieve a turnaround with price subsidies. What it really takes is technology innovation. At the end of the day, it's really about merchants being able to provide to customers the best products at the best prices in a way that's sustainable for the long term. Alibaba has a lot of experience in empowering merchants to do that, and we have deep pockets with 55 billion US dollars in net cash. In terms of capital allocation, there was a good question here about Alibaba's free cash flow of about 11 billion US dollars in the quarter. They then went on to spend 3.3 billion US dollars in the quarter on share repurchases. So the question essentially was, could there be even more repurchases, or could there even be something like a dividend paid out from Alibaba? So management said, you touched on a couple of things. First, as you will have seen from various media reports, we have been divesting some of our investments. When you make those current strategic investments, you're planning on exiting at a certain point. And in terms of the buyback program, that's already been upsized from 25 billion US dollars to 40 billion US dollars, and we still have 21 billion US dollars of quota remaining in that program. So rather, what's on our minds at this point in time is how we can best make use of that remaining quota of 21 billion US dollars, how to deploy it and when to deploy it in line with the authorization given to us by the board of directors in order to further enhance shareholder value. And finally, another two-part question here from one of the analysts on the call. Firstly, it was about kind of that shift in GMV versus CMR revenue, or gross merchandise value versus customer management revenue in the China commerce business. And the kind of second part of the question was about, basically what's going on with Daniel Zhang, the Alibaba CEO, becoming also the Alibaba Cloud CEO and manager, at least in the interim. So they said with CMR versus GMV, the issue has been a high rate of order returns due to logistics problems. The consumer will pay, then there's a logistics problem, and the consumer will return the goods. They said overall we're seeing a recovery in logistics and a decline in returns, so the gap between GMV and CMR is narrowing. And this is what Daniel Zhang had to say about kind of taking over the cloud business. He said, we see the development of this industry not only in China but worldwide as an absolutely historic opportunity. Something I'm extremely passionate about, and we absolutely must not fail to seize and capitalize on this crucially important historic opportunity. We're the top cloud vendor in China and indeed the world, and we must get back to what cloud is all about, leveraging cloud to make available computing power. We need to ensure that we're doing that with extremely high availability and high security, and we need to make sure that we're consistently exceeding customer expectations around stability and security. I think for Alibaba, we need to be firmly rooted in China, but also have a global vision. Cloud computing is an industry that's built on scales of economy. If you have no scale, you have no economy. And we need to be able to enable our users not just to use the cloud, but to use cloud well and to achieve demonstrable economic benefit from leveraging those cloud offerings. So overall, a lot happening at Alibaba and a kind of a lot to get through in terms of their latest earnings release and latest results, but there's pretty consistent themes across the board that seem to be a continuation of what was happening last quarter. A kind of flat to modest revenue growth in most of their lines of business, but significantly improved profitability. Also a greatly simplified kind of method with capital allocation, basically taking the cash flow and funneling a lot of it towards share repurchases at this point, and some interesting changes in terms of the management of some of their potentially very key future businesses, with Daniel Zhang taking over cloud. Free cash flow generation from Alibaba remains very, very good, and they also have a pristine balance sheet, over 50 billion US dollars in net cash sitting on the balance sheet. I think there was also a lot of clarity in some of the comments from management in the Q&A session around the future opportunities and more broad kind of growth opportunities for Alibaba moving forward. Pretty strong GDP growth in China is again starting to be forecast, but interestingly also that mix in GDP over time, with China shifting more towards consumption and IT as kind of larger components of GDP. So you have a couple of nice potential growth engines there for Alibaba. So I really hope you enjoyed that detailed run through of all of Alibaba's latest results from this quarter ending December 2022. If you did enjoy it, please give it a like. If you've made it this far in the video, let me know your thoughts on this quarter from Alibaba in the comments below. And if you haven't subscribed by this point already, please be sure to do so. It really helps me out here on the channel. But that's it from me for this one, and I'll see you in the next video. Cheers.